Hello and welcome to another episode of the Investor Financing Podcast. Today we have an amazing guest, and I'm excited because we're talking about the capital stack. We're talking about how these large transactions get done. And although I've been originating loans for a long time, this is way above my pay grade. And so I'm going to learn a lot in this episode. And I know you guys who are going to be watching this in the future are going to learn a lot. Please welcome John Azar. John is the founder and managing partner of Peak 15 Capital, a capital advisory and syndication firm servicing commercial real estate operators and sponsors in identifying, sourcing, and securing their equity capital stack. Anyways, John has, his background is amazing. Previous to that, he was at Boston Venture Partners. They had billions of dollars that they had sourced and managed as far as structured finance. So he knows what he's doing. And this is going to be an exciting show because you're actually going to learn about how these larger deals get done. If you're out there and you're doing larger deals, this is going to be a perfect episode for you. Or if you're getting in the game of syndication, John helps new syndicators get some education as well. So this is a very versed person here. So thanks for joining us, John.
Thank you, man. Thank you. I appreciate that. I'm always humbled to get to tell anybody anything. So I appreciate it.
Okay. Well, I mean, you've been in the finance space for a long time. You're a co-host of a podcast. And then Peak 15 Capital is kind of like the newer baby that you have. I mean, you also have the other company, which is called, it's managing member of MACC Venture Partners, which you guys have owned and operated thousands and thousands of units. So you really have a wide understanding of the real estate game. So we're happy to have you here. So anybody looking, anybody's watching this show, can you kind of explain kind of a high level of what Peak 15 Capital capabilities are and where you like to focus your attention to?
Sure. Yeah. Thank you again. Peak 15 is definitely our newest venture and our baby, as you called it. We launched it in really right before the pandemic, but it was the pandemic year of 2020 was our first full year in operation, which is great and bad at the same time. I mean, 2020 was a great year for anybody who's launching something, just because if you make it through 2020 into 2021, you got something that's worth pursuing on your hands. And you also learn a lot of lessons from 2020. We certainly walked away with a lot of lessons from 2020. Peak 15, in short order, we provide co-GP services, co-GP equity, as well as just regular JV and LP equity to sponsors and operators across the United States, not just in the Southeast. We are, I guess at hearts, a sort of a deal junkies and equity placers for a lot of the sponsors out there. But we also do a lot of co-GPs deals on selective deals that we like. That and our co-GP deals are only on multifamily, whereas when we place equity, we're placing equity across all flavors of the rainbow. So it's not just multifamily. We'll place equity for industrial, hotel conversions, student housing, commercial office, ground up development, and we've done all of that in the past couple of years in our short time here, and we've been blessed by a great community of sponsors and operators who've known me through the years and have gravitated towards us and wanting to know more about our services in the past couple of years. And we've been very lucky to work with some amazing operators and investors in the past couple of years.
That's exciting. Where do you see the most demand right now in your services? Is it still in the multifamily space? Are you seeing a lot in industrial type assets? What type of assets are really kind of taking off in 2022?
Yeah, look, multifamily is going to be here no matter what. I don't care what people are telling you. What's going on in the market, whether it's going to go sideways or whether, cap rate and interest rate are going to equalize. There's always going to be people moving around. There's always going to be families renting. There's always going to be young professionals renting. Not everybody in the United States is going to buy a house all of a sudden, and people are going to stop renting. So the fact that, rentals are going to just all of a sudden, I don't know, people sometimes act like, rental's going to just go by the way of the dinosaurs, and that's just not going to happen. That's just not realistic. There's always going to be people are going to rent it. So the multifamily game is always going to be here to stay. How it's bought and sold, that's different. That's what's going to change in the next couple of years. We've definitely seen a huge surge in industrial acquisitions. The industrial returns really are what made it so attractive for sponsors to gravitate towards industrial acquisitions, because the returns on industrials have been matching, if not exceeding, what traditionally multifamily returns have been. And it's an easier equation to kind of deal with. It's somewhat of an easier underwriting. It's easier to on the maintenance perspective. You're not really doing a whole lot. It's really just almost like buying a box and leasing it out. So it's not really, I mean, I'm simplifying it, but it's not really that complicated. You're not dealing with a lot of same complications that you deal with for multifamily. There are no renters moving in and out every other month or every couple of months. There's not a whole lot of, hard usage going on. I mean, if there is, sometimes it depends how you handle your industrial. Sometimes if it's a triple net lease, it's up to your guys to people who are to your tenants to take care of their assets. So it makes it a lot more attractive. We've also seen hotel conversion projects that have bloomed in the past couple of years, really, and that's easily explained because of the hospitality industry have taken a big hit during COVID, but that has started before COVID. The hospitality hotel conversion project, but it certainly got a lot of claws into it after COVID, and people gravitate towards that a lot more. It's a simpler equation. A lot of hospitality locations are usually zoned for both hospitality and multifamily. Not very often do you see zoning is only for hospitality and not for multifamily. Even if it is, it's usually an easier conversion to that. So that's one factor. The other factor is that you already have the box ready to go. All you have to do, especially if you're buying hospitality assets that are somewhat short-term residents, like Residence Inn or something like that, where it's they already kind of have a kitchenette or some kind of a water piping already, or all you have to do is really kind of reconfigure the structure of the rooms. And the third is the expectation with the growth of the multifamily and tenants moving into different multifamilies. You don't have to be concerned about building huge units. So you don't have to worry about building 1,000 square foot units. You can probably get away, but depending on location, obviously location is still matters, is still king. It depends on location. You can get away with having, a unit that's 300 square feet and that still be desirable to rent out, as a multifamily rental from folks. So all these factors kind of made the hospitality conversion projects really, really attractive in the past couple of years.
Yeah, and there's not much high leverage senior debt, so it makes it more for what you're doing too. They're needing this equity gap that you're bringing this into. Can you paint the picture of like a avatar sponsor that if you're talking to that sponsor, why would they work with you? Kind of paint the picture of how you facilitate the equity injection.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hello, Beau here, host of the Investor Financing Podcast. Are you a lender, real estate professional, or vendor that provides products or services within the real estate investing and business owner space? We are offering a few sponsorship opportunities to get in front of a highly targeted audience. If you're interested, please click the link below for further information. We look forward to talking with you. Thanks. Make it a great day.
Yes, I tell everybody, it sounds kind of cliche, but we are a company built by sponsors for sponsors. So the thing that differentiates us in the marketplace as an equity placer or as a capital placer in general is the fact that I am a sponsor. We've been in a sponsorship. I'm still a sponsor, not been. I am still a sponsor on an active basis. We still control, we still have a portfolio on the other side of the equation of, 3,000 units or so that we're still managing. So I understand the realities of a deal, from a different perspective of sort of run of the mill, sort of a Wall Street firm that knows the numbers, yes, and may have deeper reach or deeper pockets or obviously bigger staff, but we are certainly approaching every deal from a syndication sponsorship perspective. If we analyze the deal and look at the sponsor the same way as I would look at a deal if I'm buying it myself, if I want to do business with this sponsor, because a lot of times it could end up being that I do business with the sponsor myself, not just to place equity, but to actually co-GP with them on a deal. So our due diligence criteria is a little bit different. The way that we approach it, we approach everything from a relationship perspective. If it's somebody that we can build a long-lasting relationship, or if it's a relationship that we can feel very comfortable pursuing and having, and someone I can take and present well to our institutional investors, and that's how we approach it. If I see something wrong with your underwriting, or if I see something that's completely off basis, I'm going to tell you, and our relationship guy is going to tell you. We're not going to sugarcoat things, because it doesn't do you any good for me to sugarcoat something and tell you, yeah, this looks great, and when in fact it doesn't really look great, because I'm not going to take the deal to our institutional investors if it's something that I'm not buying into myself. So that's that approach made it a little bit makes our process different. And the other part of our process is we're not a buckshot approach. We're not going out there and blasting a deal out to 5,000 people and hoping that somebody's gonna bite. It's not a fishing expedition. We're going out there with solid relationships. We're making deliberate reach outs to our institutional investors, institutional partners, and family offices, and getting feedback and going back to the sponsor and saying, hey, this is what we've heard. I don't know what you want to do. If it's bad, then we'll tell you, like, hey, listen, this isn't working on this side or that side, or this number doesn't work, or this factor doesn't work. And and they can do with that feedback as they wish. If they want to change it, that's great. If not, that's fine too. Or on a positive side, we'll go back and say, hey man, they love this. This is great. This is fantastic. Let's move forward, see if we can get you a term sheet. So our approach is definitely very, very hands-on, very relationship driven. And in some instances, we put our own skin in the game alongside of the sponsors.
And where does the institutional, where do they like to be minimum? Like they like at least 5 million. Is that like the minimum on these institutional, where family offices might be a little bit more liberal?
Yeah, so we use the word institutional a little bit more liberally. We're not saying institutional. It doesn't necessarily mean that everybody we deal with is pensions and endowments. And I think that's what people sometimes think of when they think of institutional. To me, institutional just means you could be a private equity shop that has a $50 million fund that is going to go out there and place it with sponsors. It could be a family office. It could be a large family office. It could be a hedge fund, but of course it could also be the pensions and endowments which we deal with. At a minimum, I would say probably 4 to 5 million. Maybe it could be 3, it could be as low as 3 million also on a deal. It just depends. I'd say our sweet spot falls between 5 and 15 million on our deals, but we've certainly worked on deals that are 3 million, 2.5 million, and we worked on deals that are 30 million, 40 million. So it just depends.
Wow, that's great. Will you walk me through like a deal that you've structured? Doesn't have to be specific, just kind of high level details of how it all worked and came, and like just like the kind of like a high level case study of a project on how everything came to be, and just so we can paint the picture of exactly how you work and how you structure these deals.
Yeah, absolutely. So sometimes we bring in a sponsor who has a project that maybe they've already raised a decent amount of money for. Maybe they've taken care of 30% of the equation or 40% of the equity stack. We would bring them someone to the table who would write them one check. We're not going out there and raising from retail investors. We're going out there and raising from private equity institutional guys. So what we're bringing to the table is one check approach. We're not going to bring you 10 different checks. We're bringing you one person who's going to write one check and and that's what and that's the power, and the power in that, and the compelling part in that is that, you know, it is one source, one check. They are, and if it works, if the relationship works, they become more of a programmatic partner for you, and hopefully they'll invest. The hope is that they'll invest in, you know, multiple deals, you know, going forward. The downside is that, yes, you probably end up making less from the GP economics perspective when you have an institutional partner than you would if you were to go out there and raise from, you know, a retail syndication from high net worth investors and bring a bunch of investors to the table.
Oh, can I interrupt you real quick?
Yeah.
But usually, like on syndicators, usually like they have, you know, you're going to get, they actually, if you bring in more, like a limited partner brings in more equity into the deal, they get a bigger return. You know, a lot of the syndicators, because you can hear, if you put 100 in, you put 500,000, or you put $1 million, that's how my buddy does his syndication. So it makes sense if you're going out to a family office and they're going to stroke a large check, that their returns are probably going to be higher than the other limited partners in the deal, right? Essentially.
Yeah, it's not just that necessarily. Yeah, their returns are going to be higher just because obviously they're putting a lot more money. But if you are just simply let's take fees for instance. You know, all syndicators and sponsors charge certain type of fees, whether it's acquisition fees or deal level fees or construction management fees or whatever it might be. I mean, usually it's like the asset management fee. The two biggest fee are asset management fees and acquisition fees. Those two fees get to be negotiated a lot more aggressively when you bring an institutional partner than you would a retail investor. Retail investors just simply don't have the power to negotiate that down with you, because when you're going out there and raising $5 million from, you know, I don't know, 20 different investors or 30 different investors, you know, each of them is putting in 50 to 100 grand into your deal. They just simply don't have the buying power to tell you, hey, I don't like your acquisition fee. So, you know, the returns are going to be great, and they're going to have to hopefully contend with good returns, and hopefully you're offering good returns to those investors, but they can't change the parameters of the deal. Whereas when you have someone coming in and writing you a check for 90% of your equity stack, you know, let's use that same $5 million example, and they're going to write you a check for $4,900,000. They're going to tell you how high to jump, and you're going to have to jump. So if you want that money, you know, and I'm not saying that all people who are providing that type of equity are going to negotiate everything down for you. Sometimes they do, sometimes they don't. Sometimes they may not have any problem with your acquisition fees or asset management fees. Sometimes they want to either, you know, split it or have it at a more reasonable level to their expectation. It really depends. There's no cookie cutter approach to this business. I can't tell you that one deal, the way that it was structured, is going to be representative of all deals. That you know, I would be putting a false sense of what the deal parameters look like for you. You know, if some people would come in and take, obviously they would structure the waterfall in a different way, and waterfalls and deals, for those of your listeners who are not familiar with how they structure waterfalls, is usually what you pay your investors and what you pay yourselves as a GP sponsor. So the waterfall splits are going to be structured differently, could be structured differently from when you bring on an institutional investors as opposed to a private retail investor. Again, a private retail investor is probably not going to mess around with your waterfall schedule, because you present them what they may not like it, so they won't invest with you, but they either like it and invest with you, or they just don't like it and don't invest with you. Whereas institutional investors, if they don't like something, they're going to tell you like, hey, we'd still like to do the deal with you, but you got to change this and that or that.
That makes sense. Yeah. See, I'm getting an education done on Friday. This is great. It's and so the equity process. So basically, somebody calls your team and, hey, we got this under contract and we've raised X amount. Here's the deal. Here's our pro formas. Here's our deck and all that. They send it over to you. Your team does an analysis of the deal. And then if you think it's probable, you send some kind of engagement agreement to the sponsor. And then you go out and you're talking to your different partners that you've created relationships with over years and years and years and years. You find one or two that are probable. You kind of go down the rabbit hole with those equity sources. you find one that the terms seem like it's good for the sponsor, good for the equity partner. They then underwrite to an LOI, a letter of interest. Essentially, you get that back to the sponsor. They're interested. They sign. They usually pay a retainer. Just kind of like the debt side, the equity players are doing the same thing. And then they're also, from there, after they do due diligence, they're also giving a commitment at some point, right? Because then okay.
It's slightly different than the debt side. There's no retainers necessarily on the equity front. It depends and it's a term sheet. When they usually if there's any kind of an agreement, it usually starts with a term sheet. So that's what we try to do. We try to bring every equity guy when we bring him to the table to a sponsor. We're trying to drive to a term sheet, to have an agreeable term sheet between the parties. The term sheet generally outlines what they want out of the deal, how they want to see the waterfall schedule, what they kind of want the splits to be, what they're giving the sponsor leeway on fees, fee splits. It should outline everything. The term sheet generally outlines everything, and hopefully that will make determination for the sponsor, like whether I want to pursue this route with this investor or not. And if it is, then they go forward, and hopefully the deal would be consummated upon closing, because that's when all money gets invested on closing. Sometimes they will, we have investors that will go in and input some money into the deal from an earnest money perspective if they got brought in early enough into the deal, and if they love the deal and they like the sponsor, they'll put in their kind of chunk into the sort of the earnest money that would go on the table. Not usually the hard money, but usually any money, soft money that would go into the deal. They would sometimes put that in. And hopefully kind of, walk that deal to closing. When we look at a deal from a co-GP perspective ourselves, it depends on the deal. We would go in obviously early enough with the sponsors and sign on the deal. I would personally sign on the deal sometimes myself, and obviously share in some of the the GP pursuit costs and stuff like that with them. Sorry.
No, that's great. And so let's just say the sponsorship is a little bit green. They've done a few projects and you're getting pushed back. I mean, it's the same kind of scenario. Sometimes some of the equity players don't like the track record. They think the sponsor might not be as well established. And it's the same thing as when you're seeking debt. I would imagine that sometimes you got to bring a new team member on to get the equity players involved, that somebody's got a little bit more track record, balance sheet, and so forth. Is that
sure?
Because really on these equity deals, it's not, they have no real recourse other than what's in the deal, essentially, right? Like these equity lenders investors are putting their capital at risk, so they're vetting these sponsors pretty hard. I would imagine that they don't want people with one or two projects. They want to see usually probably a 5-10 deal type of track record at least. Is that what you're seeing mostly?
Yeah, it doesn't have to be 10 deals, but there's no magic number per se. It depends on the background of the sponsor, what they've done, who they've, how they've done it, what they're involved in. I mean, yes. I mean, if somebody who's never been in the real estate industry before, and I don't know, maybe just finished college and they're putting their first syndication together, yeah, that's probably not going to work. They're not going to get funded from an institute, or they're going to have a pretty hard time getting funded. Couple sponsors who may have left positions at places like, I don't know, BlackRock, or they used to be principals at some bigger shops. And they open up their own shop and they're doing, first or second syndication. They got background to support it. I mean, so they may get funded from institutional guys because they personally have the experience to carry on, the syndication, and they know what they're doing. So it's not about how many deals per se. It's very much about the sponsor themselves. The sponsor's experience and what they've done and who they've done it with matters a lot to a lot of the institutional guys. That matters more than the actual deals that got consummated for that particular company. You know what I'm saying? So, I mean, it may be a new company that have only done 2 deals, but the sponsors themselves came from a very, very rich and experienced background in real estate. That makes a huge difference.
How hungry are the institutional family offices right now? I mean, like when you send them a deal and it's like, are they pretty responsive to you now? Like, because that's what they do, right? They deploy capital. So I would imagine they're probably pretty quick most of the times on rendering a decision if it fits their box or not.
Oh yeah, yeah. No, we generally would get. I mean, we know ahead of time some of what some of them would like and don't like. So when we're sending deals out, we're sending them deliberately to people that we know they like those type of deals. And then yes, the turnaround on whether they like it or not, it usually happens within days. I mean, within a week, we hope to get an answer like, yes, I like this enough to explore it further, or no, I just don't like it at all. So, and we go back to the sponsor and say, hey, listen, this is what we heard, and this is what we think is happening, and proceed forward. Obviously, we have multiple sources that we go to, so we're not just stopping at one or two people or three people when it comes to a deal. But obviously, if we come across if we come against a brick wall and everybody's saying no after we approach 10, 12 people, then there might be a problem with the deal or the sponsor. I mean, so if you get 12 no's in a row, then there's, and knowing that these guys typically look at this type of deal, this type of sponsor, this type of market, as long as you're getting some of the parameters correctly, but they're saying no for one reason or another, there's got to be some deeper reason, whether it's the sponsor that just, they have a problem with the sponsor, they have a problem with the returns, they have a problem with assumptions, they have a problem with expenses. Could be anything, but we'll ferret that out and go back to the sponsor and say, listen, here's what we heard, and here's the breakdown. And a lot of times they'll, maybe sometimes the investor will tell them themselves to the sponsor, like, here's our feedback, because we always ask for feedback, not just a no. Nobody likes to. I don't mind a no, but just tell me why it's a no.
That makes sense. Yeah, I like that. This has been really, really great. I appreciate your time. Can you also talk about, I know you do some coaching. You're helping some of the newer syndicators, and I would imagine that your coaching is actually really good because you have the operator side, you have the lending side, you have the equity side. You understand the game, I think, as well as anybody, because you've worn a lot of hats over your career. How are you helping the syndicators out there, kind of get them started, actually helping them probably source debt, that kind of thing, and get their equity positions put together?
Yeah, our coaching program is not, one of those huge coaching programs where we're going out there and have 20 students or something like that. We're actually I'm selective, not just because selective of the people, I'm selective of my time, because I'm at the end of the day, I'm a deal guy. I put myself out as a coach, but I'm mostly a deal guy. So I never want coaching to be a disproportionate part of our business. I mean, coaching is something that I love doing, and it's close and dear to my heart, just because I've always been in mentoring and coaching, throughout my life, even when I was not in commercial real estate all the time. I got started in the industry on the equity side and the investment side of the business with places like Morgan Stanley. But I've done mentoring and coaching even back then. So, my approach to coaching is that, hey, I want you to understand all facets of the business so you can make a more informed decision on what you want to do and how you want to approach your acquisitions. You need to understand the numbers. You need to understand underwriting. You need to understand that the deal has 3 or 4 different sides to it. It's not just the numbers, or it's not just the location, and it's not just the, how you do your due diligence. It's not just what you end up doing when you close. There are all these have to be in variable steps together, and they work together in concert in order to make you a successful syndicator. And that's what I try to coach people about. It's about sort of the process from A to Z, from not just identifying assets, but really from forming yourself and making yourself into a strong syndicator that you can grow, to finding assets, to sourcing capital, to working with investors, to working with lenders and brokers, to closing on a deal, and to managing the deal and hopefully selling it, successfully afterwards.
Awesome. Well, this has been fantastic. I got so much out of this, selfishly. I know everybody watching this is great. It makes your mind think differently about how these deals actually get done, the pieces. I mean, there's there's syndication groups that probably just always go and use companies like yourself, because it's like, hey, we don't want to raise mom and pop accredited investors 500, 200,000. They're just would rather get the check stroked, with one equity player, right?
But you have to start with that though in order to get to the equity players out there. I mean, you have to. I mean, every syndicator have to start with the mom and pop investors, retail investors, in order for you to get to the point where you are ready for institutional, investors or family offices, because you're always going to need those retail investors on a lot of your deals, even if you are at a level where you're sourcing $20 million of equity, because a lot of times you have to put together your own little piece of the equity from a GP perspective, from a general partner perspective, and that piece of the equity for your GP portion, you could syndicate it out to your own investors, to your retail investors. So you'll always need those retail investors in your business, or unless you have a GP partner who will put up that money, which is if I was to do a selfish promotion out there, is we are launching a co-GP fund in the next few months that will do exactly that. That will go in with syndicators to help them on the GP economics.
That's awesome. Well, this has been great, and everybody, you can go to peak15cap.com to learn more. Is there any other places you like to send them, or is that the place to go?
Yeah, it's peak15cap.com, and they can always reach me. I'm on LinkedIn, Instagram. My email is Azar, Azar at peak15cap.com, and I'm like I said, I'm on LinkedIn and Instagram and all that kind of stuff.
Awesome. Thank you so much, everybody. I hope you enjoyed this as much as I did. We'll see you on the next episode.
Thanks, Beau. Appreciate you having me.